Welcome to the monthly Fixed Income Outlook, your guide to navigating the complex world of bonds, macroeconomics, and interest rates. Joining with us is Manish Banthia, the Chief Investment Officer of Fixed Income. Good to have you here, Manish.
Hi, thank you.
My first question to you is: what is the reason behind the sharp movement in bond yields in the recent month?
Look, the market has largely got impacted because of the Gulf crisis, and we've seen that over and over again. There's been anxiety in terms of whether we are in a state of war or there's enough negotiation which has happened, which kind of brings lasting peace. And because of the reason, we've seen that there's been a lot of volatility in the markets. We are not sure yet whether we have a lasting solution. But given the fact that both parties are ready to negotiate, our baseline view is that there will be some negotiation, which both the parties will ultimately come to, and that should be good for the markets.
My next question to you is that given that yields are high now, do we see any scope for yields to come down in the near future?
Look, I think at the current stage, most of the positives which the market was looking for in the very short period of time, they're behind us, and therefore, in the very short period of time, I think. Market looks a little more range bound. The RBI was dovish in the policy, so there will be some capping in terms of how high the yields can go, and for the yields to go lower, there has to be some positive trigger. So I think the market is stuck in a range, broadly at this point of time.
That makes sense. Now, coming to the global view, US Treasury yields are rising. Is that of any concern for Indian bond markets?
First of all, I don't think the US markets impact India to a very large extent, given the fact that RBI has kind of got a solution in the near term for the BOP situation and the external flows. But having said that, I think global markets are very interesting, and there's a lot of anxiety in terms of the new Fed governor, and given that he's chosen not to guide the market as much as the earlier governors, generally bond volatilities globally has gone up. One of the interesting things which I observe in the global market is coordinated action between Bank of Japan and the US Treasury, including the Fed, on intervention in the Japanese yen markets. And which is why I think this is an expansionary move from the both central banks taken together. And it should have an impact on risk premiums, and risk premiums generally should fall, which also includes long-term bonds because they're also seen as risks at this point of time. So effectively, it means that there's a good chance that curves can flatten at this point of time globally.
That's insightful. Coming to a related point, the Bloomberg index inclusion is deferred, as you may know. And we saw bond sales by FPIs in the last, after it was announced, the deferral was announced, that there was a major sell off in Indian GSECs. So, do you expect this sell off to continue, this pressure?
Of course, people are looking towards bond index inclusion, and because of its deferral, it kind of takes away the immediate rally which the market was looking at. But having said that, I think the demand supply in the market is fairly balanced. We have good deposit growth within the banking system. And given that the banking system is, at this point of time having very low liquidity, coverage ratios, the effective demand from the banking system for SLR assets should be quite buoyant. And, the other point is whenever normal growth is good, generally we tend to see that flows from EPFOs, pension funds, that's also, pretty decent. So my expectation is generally, we have a fairly good demand supply for government securities in the market. And on top of that, a good normal growth also means that tax collections, also look pretty decent and buoyant. So markets don't have concern on fiscal deficits like they had 3 months back, and demand side also is favorable. So I think broadly, even without the bond index inclusion, it's a fairly balanced market at this point of time.
That connects many dots. Now, my next question, which summarizes a lot of this, would be: what is your outlook on the Indian bond yields?
I think one important point which one needs to know is that the underlying economy, and I've been repeating this again and again, that the underlying economic momentum is very good. And to me, that is an important perspective to look at when you look at the bond markets. A good economic momentum means that at some point of time, core inflation will start to pick up, your output gaps will close in, and RBI will have to normalize policy rates. And in that perspective, I think I don't see very large amount of capital gains being there for the markets. But having said that, the overall level of yield in the market is attractive, and therefore it's a good market to be in. But you will have to look at the market from a carry perspective. You can't expect too much of capital gains in the market. Even when I talk about long bond yields, for me, they are more like carry instruments. They're defensive carry instruments. I don't expect too much of capital gains to be made even there as well. So we are at a point of time in the bond market where most of the returns, in my view, should come through carry.
And what would be your recommendations in debt mutual funds at this point of time?
So largely, I think investors should remain in the shorter end of the curve, given that the corporate bond curve is pretty flat, and the 2-year, 3-year part of the curve is pretty attractively priced today. So funds which invest in 1 to 3 year corporate bonds, I think they are an attractive investment today, which includes starting from the floating rate bond fund to the corporate bond or the short term bond fund and the banking PSU bond fund categories. They all look attractive right now. Of course, the very short end of the curve, which includes the low duration and the ultra short term strategies, are also great strategies for parking money. The good part is that unlike last year, yields are much more attractive for investors to be there in the market. And the risk that we had of these low yields moving up, that's fairly played out in the last 1 year. So to me, bond markets are stable markets right now with decent carry.
Thank you, Manish, for the wonderful insights, and thank you for your time.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.